This is a Momentum Media production.
Welcome to the Smart Property Investment Show, the podcast by investors for investors.
G'day, how you going? Phil Tarrant, host of the Smart Property Investment Show, here for a special edition, Finance in Focus. You heard it here first. Here we are, a new monthly update on what's going on in finance, and we're recording on the day that the Reserve Bank of Australia gets together, the first Tuesday of every month, to work out what they're going to do with interest rates. We're going to break it down. We're going to unpack it, try and work out what it all means and what you can do about it. Joining me in the studio to chat this through, a good friend and partner of the Smart Property Investment Show, Finni Mortgages, finni.com.au. Joining us, CEO Paul Glossop. How you going, Paul?
Good, Phil. Thanks for having me again today, mates, and excited for this new initiative to get across the airwaves.
Yeah, absolutely. I've been looking forward to it. Get stuck in, get behind us. Any questions at all, we're happy to discuss it on Finance in Focus. Editor at smartpropertyinvestment.com.au is where you can go and you can answer anything that you want to know about mortgages, tapping into the knowledge and the team of finni.com.au, mortgage brokers. Now, Paul, here we are. The Reserve Bank of Australia again has up rates 50 basis points. We know we're in a rising rate environment. When's it going to stop?
Well, mates, that's the truth, is that here we are. It's another rate hike, which was relatively, I guess, across the board assumed and predictable. And it's been the case for the last couple of quarters, or couple of months rather, since we've been catching up talking about this new cycle of increases. The question is, when's it going to stop? Well, we're now starting to see that the markets are really starting to not necessarily be as bullish as to where they were seeing the end of this, which was potentially up around that 4%, even 4.5% cash rate mark. We expect we're probably going to see around about a 2.5 to 3% cap, which will probably be achieved by early or quarter one next year. But in the same token, we're also now starting to see a lot of the pricing in the market start to expect that we'll start to see a rate cut cycle commence around about this time next year, and probably find a floor around about that 1.5% mark. So it's going to be a bit of a roller coaster, literally, I think, on the rate cycle market. We're going to see it go up and likely come down, and then find a bit of an even keel around about quarter three, quarter four next year.
Yeah, I don't want to overcook this podcast, Paul, by getting too much in the economics of it all. And if you want to know why the Reserve Bank of Australia is doing what they're doing, go and read the minutes. They put it out after the announcement to give you some sense for how they're seeing the world and what they'll do over time. Let's just say we're still in an environment of flux. Inflation is still rising. There's still a war in Europe. We've been chatting about this. So the drivers of inflation are largely still there. The drivers is upward rate environment is still there. So I don't want to dwell on that. What I want to dwell on is what you can do about it. Now, Paul, I just got off the phone from my accountant. I spoke to him a half an hour, and he was giving me a good sort of kick in the backside going, Phil, you don't understand. I reckon it's going to be one of the great opportunities for buying investment property through this period of time. While most of the media will talk about doom and gloom of rising interest rates, there's the other side of the coin, absolutely, isn't there, Paul?
Yeah, mate. So, look, we both share the same accountant, actually, Munzrul Khan, KHI Partners. And look, we don't share any profits from any plugs that he gets. But look, he's an extremely well-versed.
I want him more to myself, Paul. He's too busy already.
Unfortunately, that's probably the feedback that we get across the board, is that he's just too busy. But look, in that same token, mate, he's probably one of the best property advisors and one of the sharpest minds in the property space that you and I have no doubt met. And we get this opportunity quite seldomly in the property space to A, get your finances ready, but B, to buy and buy very well. And I think that advice that you've just received the last half an hour, mate, is quite sage, is that we're only going to get this opportunity probably once every 3, 5 or 10 year cycle. And typically it's more the latter rather than the former. But this is the time now where we're seeing some huge opportunities to start considering buying. I personally reached out to my senior broker at Finni, funnily enough, who I'm now preparing for my SMSF to get a few investments in that portfolio as well, because the opportunities are really starting to present now for what we see over the next 10, 15 years. So if nothing else, not talking about money, but talking about property investment and property buying opportunities, they obviously go hand in hand with getting your finances ready and buying the correct asset. But for me, these opportunities and these cycles in the money markets is what presents the time for us to really get busy.
Look, property's a game of finance, so you've got to be finance first and using that to help shape your property investment strategy. And we spoke about this, Paul. There's probably two sides to this coin. It's what is the impact of this and it may hurt me, or what is the impact of this and how I can be opportunistic around it. And I want to get onto the opportunity stuff because both me and you are wired that way, and no doubt a lot of our listeners are as well. But let's talk really tactical. What do you do about this if you are struggling? If you're combating rising interest rates, your cash flow might be decreasing and diminishing. What do you do about it?
But this is the time where property owners, whether they're owner-occupiers or investors, if they've bought and they're stretched 6-12 months ago when the markets were as cheap as they've been in a lifetime, and they're now starting to get more expensive, and they're starting to think, what happens now? I can't afford, or I'm starting to get stretched really thin here. This is where the big banks make their money. And this is where people who have and hold loans with particularly the big banks, when I talk about the big four banks, I'm not going to go through them individually. The reality is that they earn all of their money in what is deemed to be in the industry a loyalty tax. And that is the tax that we pay for being lazy. And essentially what we're seeing now is that there is a discrepancy somewhere between 0.7 and 0.9% interest for every single holder of an existing loan with the big four banks versus new clients. So what that means for all intensive purposes is that if you've got $1 million with, let's pick out CBA because they seem to know they're one of the biggest, or they are the biggest, and they typically get the lion's share of the market. If you're an existing client, you are essentially getting slugged anywhere between 0.7 and 0.9% more on the equivalent loan to where if you were a client who was going to apply for a new loan with CBA, because ultimately they're hungry for that new business. And anyone who is going to sit back and think that they've got the best deal because they're loyal to the bank, think again. This is the time where they make their money, and this is the time where anyone who's thinking that they need to sharpen up their rates, they need to reach out to their broker, who needs to then essentially say, well, you're getting priced here. If you go over to this bank, you're going to get this rate, and even potentially a few perks on cashbacks and equity releases and a range of other facilities that you simply just won't get with your existing bank right now. So if you're going to sit back and rest on your laurels and have the woe is me mentality, unfortunately, you're going to get what you deserve. I think this is the opportunity for people to really sharpen the pencil and set themselves up for the next 5 to 7 years and beyond.
Yeah, I agree. And let's be clear, doing that, you can call out your banks right now. And I'm in the process of those banks I'm with right now saying, hey, if you want to keep my business, you've got to keep my rates sharp. And I expect to stay on hold for a long time and get annoyed and frustrated. And I remember recording a podcast about a year ago, sharing my journey trying to deal with one particular bank. It has yellow and black in the logo, and it wasn't very satisfied at all. I got to the conclusion I wanted, but it is a hassle and it's a massive pain, and you're going to get annoyed and pissed off, but, strap in and get on with it because you will save a considerable amount of money. Now, that's something you can do to try and keep your cash flow in check. On the other side of the equation now, you can always generate more revenue. And if you haven't reviewed your rent recently, I highly recommend that you do that. If you're really finding your hip pocket getting hit and you're struggling to make repayments as property investors, there's many other ways, many other tactics you can do in order to combat that. One of those things, and Paul, I'm sure your brokers would be happy to chat to anyone about it. It's about switching, just if you're on a P&I product, into something which is interest only, where you're not paying the principal off for a period of time. That can also work for your owner-occupied mortgage as well. So there's ways and means you can combat rising interest rates and the financial impact on it, but you got to get on top of it. If you put your head in your sand and forget about it, guess what? It's only going to exacerbate and get worse over time. So, Paul, no doubt the mantra is be proactive, take control, and you should get the outcome that you want, or at least it's going to alleviate some of those stresses.
You're bang on, mate. And I think the reality here, and we're doing a lot more deep diving within the team at finni.com.au now to assess where and what we're able to achieve for the average client who calls us up and says, well, I'm on this product in this position, here's what's on offer and what's available. And the reality is now we're seeing about an average anywhere between 0.4 and 0.5% for the average investor who's got an LVR of better than 80%. We're able to achieve somewhere between 0.4 and 0.5% better interest rate with equivalent products. In addition to that, we're seeing now some of those banks, as well as non-bank lenders, offering anywhere between $2,000 and up to $7,000 cash back, depending on the loan size and depending on the LVR. So if you're talking an average $1 million debt, let's not talk about $1 million loan, but let's say you've got 2 properties, $500,000 debt on each as an example. If you're talking 0.5% on that, that's $5,000 a year net just by a conversation and a change permanent. If you're adding tax onto that, you've got to go and earn an equivalent $7,000 or $8,000 a year just in your job. And that takes out of the equation things like those cashback deals, equity releases, getting prepared for the next investment. So do your math on that. Any investors who are thinking, is it worthwhile doing? Well, that example that I gave just there is essentially saying that the average phone call that we get from a client, whether they're existing or new client, typically there's about a $5,000 a year average saving on $1 million debt.
There you go. You want a new pay rise? That's going to help with the cost of living. $5,000 in your back pocket. You can even put it in to offset your mortgage, or you can go on a holiday if you want. But you're $5,000 ahead of the game. And every single person I know, $5,000 is $5,000. I'd take that every single day of the week. But to be finance ready, though, you've got to put the hard work in there. If you want to try and chase the banks and get your mortgages pulled back to where they are right now, go ahead and do that. You may need to refinance, so you've got to be finance ready to do that, which is a full application pool. Even if you're switching from principal and interest to interest only or resetting your interest only period, you need to apply for a whole new loan. That takes work, and you've got to make sure you've got your ducks lined up.
Exactly, mate. And these are the stresses, and these are the reasons why you and I both use experienced mortgage brokers who are well-versed in that space, because ultimately, if you're going to work with your bank or your lender directly, be prepared for a lot of time, both on the phone, on hold, and then with absolutely piles of documentation they're going to send you. And if you're with an existing bank and you're trying to reprice with an existing bank, unfortunately, their process includes a way to make it very difficult for you to do so, because they know there's nothing in it for them. They know that eventually you'll cave in and you'll say, all too hard, I'll just put it back over there and I'll readdress it this time next year and go through the same frustrations. Where the broker passage comes into play is, for us, that's what we use them for personally, is to go in and bat for us, as well as spend the time on the phone, the time in conversations, the time in repricing, and the time assessing 40 to 50 separate lenders to ensure that I'm getting that 0.5% difference, to ensure that I'm getting that potentially that $5,000 cash back on a refinance, because it needs to actually have an ROI for your time as an investor, not only the rates that you're going to get as a difference. And for you and I, Phil, and I don't doubt for the vast majority of the listeners, is that it's not just the actual price difference, but it's the hassle factor. And for us, that's where we find that not only are we trying to get the best outcome for our clients, but it's essentially allowing them to do what they do for a living, and us take that time away to say, look, it's not only us getting that outcome, but I don't want you sitting on the phone for 2 hours with a bank who's going to say, well, that's the best we can do. If you want to put some sort of actual, I guess, email to us to reiterate what you think you should be getting, go ahead and do it. We'll probably get back to you within 3 to 4 weeks' time, because unfortunately that's the standard response.
Yeah, like a lot of big companies, they make it hard to do business
they
with
do.
if they don't really want to, if it doesn't sort of end up. But, some banks are really cool. And I don't really like talking about specific lenders or rates, Paul, but I just want you, and we've got to be careful here, because these rates might not be available to everyone. Everyone's circumstance is different. So this is really, really super general stuff. But can you give me some sense of the rates you can still get? So everyone was saying, if your rate doesn't start with a 2 6 months ago, you're probably overpaying, right? So where's it sitting right now? What sort of sharp rates are you seeing which are available for Australian borrowers?
Yeah, and I won't name the lenders, mate, but we'll go through some of the rates and some of the structures that people should be considering. If they're not getting them, that's what's available. So if you've got an LVR, let's say you're an LVR, you bought a property 2, 3, 4 years ago, and you enjoyed some of that increase in prices that the vast majority of Australia saw over the last 2 years. The reality is, if you've got an LVR that's better than 70% or lower than 70%, which a lot of people will be sitting in that position if they've held a property for 3 years. For an investor, interest only variable, which is about as good as flexibility gets for an investor, as you know, mate. The reality is that it's around about that 3.2 to 3.3% interest only variable, better than 70% LVR is what we're seeing out there in the market. And that also, certain lenders also include some big cashbacks depending on the loan size and depending on how low that LVR actually is. If you're sitting in that sort of 80 to 90% LVR space, and again, investor, interest only, variable, those three key things, which typically is what stacks up against most applicants, somewhere in that 3.45 to 3.6. There's about 2 or 3 lenders right now that we are working with who are offering that for those people in that position. If you go down the pathway of principal and interest in that same space for investor in that 80 to 90% LVR, you're probably talking again back down to that 3.3, 3.35. And if you're an owner occupier, again in that 80 to 90% LVR, both in interest only as well as in the principal and interest space, you're probably talking in that around about that 3.2 to 3.35%. So in general, in that sort of mid to low threes, should be there. And don't let someone tell you that you have to lock in on a 5-year fixed with X amount of LVR, because there is plenty of flexibility for even some of those higher LVR positions, interest only, variable and investor, with the ability to actually get cashbacks, as well as with the ability to extract equity and prepare you for what we open this podcast with, which is actually thinking about where and what can I buy in this time of opportunity that's presenting in the next 6 to 12 months.
Yeah, and obviously being super careful there, talking about interest rates, and these things may vary, the comparison rates, there's all these different things. So that's super general. There's, you're not guaranteed to get any of that sort of stuff. It depends on who you are and what you do and how much you earn and what your footprint looks like, whether you're self-employed or not self-employed. So this is why you need a mortgage broker, because it's like a fingerprint, right? Everyone is completely unique. But if you're a property investor and you're going variable, and your interest only, you're probably going to be paying more than most people. That's just the way. That's
correct.
So get used to it. But, as we spoke about, if you're looking at the revenue side of things and making sure your rents are good, you should be okay. Now, that's talking about people who may be sort of questioning property, their portfolio at the moment. They may, worried about cash flow, looking for some certainty for the market ahead as we go through this rising rate period. Let's go on the other side and talk about opportunities. What are the smart investors doing right now, Paul?
Well, if we're talking about the smart investors and what they're doing with their actual purchases, Phil, is that what we're referring to as far as
I want to talk about, they're getting finance ready, obviously, and looking to chase some of those sharp rates. But no doubt the investors that you're seeing within finnimortgages.com.au, they're probably getting liquid, right? Because a lot of people have had significant increases to their portfolio. So if they're looking to, and this goes back to my chat with my accountant, looking to capitalize in the market, guess what? You need deposits. How do you get deposits? Well, a lot of people are sitting with a fair bit of equity in their homes at the moment.
No, completely, mate. And I think that's the key part here is if you really dig deeper and say, well, what are the top 1-2% doing? And they're typically the people who own anywhere between 6, 7 and beyond investments, which is typically that very thin edge of the wedge. When we do equate, and we had a client come to us yesterday who had 12 separate securities, 12 separate properties. Across that, they had about 15 separate loans, and they had an LVR that was around about the 59%. So on those numbers, fantastic amount of liquidity available. Serviceability obviously comes into the equation. This is where those smart investors are, because obviously you're always going to sit at a point where, yes, you can have equity, but it's always a combination of the available equity and the available serviceability. That is the point where we have to say, okay, well, that particular client, if we refer to that as what a sophisticated and clever investor is doing, who's thinking about taking advantage of the next 12 months, their role right now is they had 3 separate lenders. They had those 15 separate loans, 12 separate securities with. They're pooling it together and taking it to one particular lender who is really interested in their new business. And that new business was including both cashback, was including a sharper rate, as well as with the provision that they were able to extract equity and get that pre-approval, which was going to hover around about that $850,000 price point. And they're considering 2 separate purchases with that. Now that, as you know what very well, mate, is it's not an easy process if you've got 15 loans. But the role that our team has with that particular client is essentially to say, look, hey, our job is to make sure that we're going to those 3 lenders. We're going to go through the discharge process. We're going to go through the application process. We're going to complete the vast majority of it for you. We're going to present you with the new pricing as well as with the new lender, set up all of your different accounts, make sure your automations, all your direct debits are set up in place and you have your pre-approvals ready. That is our job. And that is what a smart investor is essentially doing right now to say, yes, I can get a better rate. Yes, I can get my money extracted. Yes, I can actually get cash back, which is going to be money in the bank as well. And I'm actually doing this all with a broker who's taking care of that for me. Because if you're doing that yourself, unfortunately, that is an enormous undertaking if you're dealing with 3 separate banks and 15 different loan applications to refinance.
Oh, yeah, good luck to you. But you're talking about smart investors there, Paul. And I like to think most smart investors probably already use a mortgage broker. 70% of Australians use mortgage brokers, and I imagine most property investors use a mortgage broker. However, if you're not happy with your broker or you'd like to another opinion on who you can work with, how do they get in touch with your team, Paul, to help them down this journey to be these smart investors?
Yeah, really simply, mate, is jumping onto any search engine, finni.com.au, finni.com.au. There's a contact us button on there, which literally will take them straight to our team and they'll contact them within the hour, if not get onto them immediately. And they'll set up a time with one of our senior brokers who specialize in that investment space within either the same day or the day after to allow them to go through what's available. Are they on the best deal? And should they stay or should they go?
Yeah, and I know a lot of brokers are busy and your team's probably flat stick, but they make themselves available to help people out if they've tuned into this.
Always, mate. That's the way we're set up, is that if any new clients who come our way, we are here to make sure that they are addressed literally within the 24-hour time frame. So it's not to say, hey, we'll go into a long queue that's going to be 2 or 3, 4 weeks down the track and all of a sudden you miss out on what rates were available today. It's to say that, hey, we get involved and we make sure that we get that response straight away.
There you go. Go and check the guys out, finni.com.au. That's Finni Mortgages. Paul Glossop, the CEO. Thanks for joining us today.
Thanks for having me again, mate. Look forward to keeping this continuity for the next few months because it's going to be an interesting landscape.
Yeah, we will be back. Finance in Focus recording of the day, on the day of the Reserve Bank of Australia. I know it's Paul's favourite day of the month because he gets so excited about money. He's one of those sort of guys. But I think everyone likes when they're going down, but when it's going up is when you probably need to be the most informed. So check in every single month, first Tuesday every month, and we'll talk about finance. See you again soon. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.